Namaskar, this is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. The monetary policy response of the Reserve Bank last year in order to tackle the economic crisis caused by the COVID pandemic was primarily on two fronts. One, it decided to prune and cut interest rates, and the second, it decided to increase the supply of money in the economy. The estimate, the hope, or the strategy was that once money becomes cheap, loans become cheap, interest rates go down, and money is abundantly available. In that case, the RBI and the government expected that borrowers would borrow and they would spend or they would invest. What was expected was that household borrowers would be encouraged to borrow and spend, such as to give a boost to spending in the economy, and that corporates would borrow because interest rates are low in order to invest in new projects and thus give a boost to growth in the economy. The other object was that at a time when the economy was slumping and contracting, the struggling enterprises would be in need of funds badly. And at such a time, they needed money available abundantly and easily in order to ensure that they survive this crisis that had come over them. Thus, money supply had to be there for all the struggling enterprises in order to tide over this deadly economic crisis that came with the COVID pandemic. Therefore, what was done was that by virtue of the monetary policy initiatives, the supply of money in the economy went up by leaps and bounds to the tune of a few lakh crores. And what was also done was that interest rates were cut substantially. Today, the repo rate, which is the rate at which Reserve Bank lends money to banks, is at 4%, which is extremely low. And the reverse repo rate, which is the rate at which banks lend money to the Reserve Bank, is at 3.35%. The purpose was that if the repo rate is low, the overall interest rates in the banking and financial system will be low and banks will be encouraged to lend. And the other thinking was that if the reverse repo rates are low, in that case, banks will be discouraged from parking their surplus money with the Reserve Bank of India and they would be encouraged to lend to the ultimate retail borrowers. This was a strategy that the RBI adopted last year by way of its monetary policy initiatives in order to target and tackle the COVID pandemic economic crisis. This liberal monetary policy of the Reserve Bank of India with an accommodative and open stance actually failed to deliver. What was expected to be achieved did not really come through. Neither did the lending by banks go up in a substantial way, nor did the consumers borrow money and spend. In fact, consumer spending has come down, and neither did corporates borrow money from banks and invest in new projects. They are at a multi-decade low. Investments in new projects have just not taken off because neither did the lending nor the borrowing take place. The bigger issue that we actually see is that apart from borrowing, lending, and investing not taking place, the entire impact of the COVID crisis and the inability of the monetary policy to be able to mitigate it or tackle it was that the cash flows in the economy today are in a lopsided manner. They are uneven, they are off center such that those who need the money don't get it, don't have it. And those who don't want the money seem to have in a very surplus quantity. It's, as we said, a lopsided situation. This uneven and lopsided position of cash flows in the economy have created what we call haves and have-nots. The haves are the ones who've got the funds and the money, but they don't know what to do with it. And the have-nots are the ones who need the money desperately, but they are not getting it. And because of that, business failures, business closures are expected to go up only because those who need the money to survive, those who need it for profitable and productive use are not really getting it. This situation of an uneven distribution of cash flows in the economy is manifest and evident in various factors and parameters that we have been noticing. And what are they? The first one, because of joblessness, because of livelihoods going down, household incomes have gone down. When household incomes go down, household savings should also go down at such a time. But the irony is that household savings have actually gone up. And that is seen in the fixed deposits which are there with the banks from households. The fact is that incomes have gone down and households are now, because of that, unwilling to spend money. They are saving money for a more rainier day. The second issue that we are seeing is that banks are flushed with funds. They are in the business of lending, but they are averse to lending. And that reflects in the growth in bank loans that is not taking place. Very logically speaking, in an economy, the function of the bank is to be an intermediary between those who have the money and those who need the money. Here, the bank is getting the money, but it is not very keen to invest, to lend, and that is reflected in the huge surpluses that the banks are parking with the Reserve Bank of India. That gets us to the third issue that we are noticing. The Reserve Bank of India has been prodding, encouraging, and nudging banks to indulge in more lending, but banks have not really been doing that. The growth of loans to the corporate sector has been extremely poor. And then what do the banks do? All the surplus money that they have got with them is being parked with them back with the Reserve Bank of India, very contrary to what the RBI is itself asking them to do. The third, what we are seeing is that large corporates have made profits and they are sitting on surplus cash flows, but they do not know what to do with those cash flows. They do not know how to deploy it profitably. And that's because consumer demand has not looked up and installed capacity utilization remains at a lowly 63%. The next irony, the next disconnect that we see is in the stock markets. The stock markets see a surplus inflow of liquidity and there is an artificial boom. An artificial boom which has got no connect with the real economy, and that's created a very risky position according to us. So the stock market, which today has got a majority of stocks which are devoid of good fundamentals, today are seeing a boom in their prices, which again is not really what it ought to be. Further, what we are seeing is that households are willing to invest but are not willing to spend. And that is reflected in the fact that a number of IPOs which come from companies with questionable financials or backgrounds are yet seeing a successful completion of the IPO process. The households are willing to subscribe to those shares. That's because, as we said, they are not willing to spend, they are willing to invest. Further, corporate profits have gone up. Corporate profits have gone up not because their sales have gone up, but because they have indulged in brutal cost cutting. And that's the other disconnect that we see from a long-term perspective. The other disconnect or mismatch in the economy which is visible to us is that while consumer demand has gone down, the inflation on the other hand has gone up. In reality, it should be the reverse. Further, India's macro fundamentals remain weak, but the rupee seems to be stable. In fact, sometimes it seems to be going stronger. And finally, what we see is that India's middle class has shrunk substantially. Because there is a mismatch of cash flow in the economy, as we said, we are seeing a bunch of haves and have-nots. The haves are the ones who have the money, but they don't want to lend. They are hoarding the money, if we call it. And in that are large corporates sitting with a huge stockpile of cash to the tune of about 11.2 lakh crores. There are banks who are sitting on money, not willing to lend, don't know what to do with it. It includes also stock markets which are flushed with funds, chasing worthless stocks. It also includes the IPO market, and it includes the Reserve Bank of India, which is getting surplus money from the banks being parked with it. And even the RBI doesn't know what to do with it in a prudent manner. That's the haves, as we see in the economy, who have the cash flow in surplus but don't know what to do with it. The have-nots are the ones who badly need it, but they are not getting it. That includes the units in the MSME sector. That includes the jobless individuals and households. That includes the NBFC sector. That includes the government of India, whose own receipts has been falling. And that includes sectors like travel, tourism, transport, entertainment, etc. All of which are badly in need of money, but they don't get it. What we are seeing is that there has been a breakdown of the function of rotation and circulation of cash in the economy, because of which this lopsided situation has been created. The function in the economy is that cash rotates and circulates such that it passes on from one hand to the other. It passes on from the haves to the have-nots. And with no spending, no investing, and no substantial lending taking place, this circulation and rotation of money from the haves to the have-nots has stopped. If you're not seeing money available so easily, it's not because there's a shortage of money or currency in the economy. It's because circulation and rotation has come to a halt. That answers the question that we raised. Where is the cash? Where is the money gone? The money is there in the economy, but its circulation and rotation has slowed down. And because of that, a number of people who should have it and should get it are not getting it. There is ample funds in the economy, but the circulation and rotation has come to a substantial halt. The second, of course, is we are seeing a lopsided situation. A lopsided situation where there are the haves and the have-nots, and they are not transacting with each other. They are not circulating the cash between themselves. And because of that, the have-nots who need the money are not able to see it. The money has gone nowhere. It is in the economy. What has happened is circulation and rotation of money has come to a halt. And that is reflecting even in the recovery and revival of the Indian economy. This is Akhilesh Bhargava signing off till we meet again. Namaskar.
Hello everyone. HW News English is 2 years old now. When we started this venture, we promised ourselves one thing, that news should remain free, because right to know is the right of every Indian. But to keep news free for everyone, we need support from some of you. And thus we have rolled out membership on our YouTube channel HW News English. But mind you, the membership is completely voluntary. The programs that we were doing earlier, that we are doing now, will continue to remain free. First level is a basic level. Here, you can be our supporter by paying rupees 199 per month. This membership gives you certain perks and benefits. The perks include unique badges in front of your name, a live show from Mr. Sujit Nair and from Mr. Akhilesh Bhargava per month for our members. You can also vote in some exclusive members-only polls. Now the second level is Super Supporter. Here you can be our Super Supporter by paying rupees 3,999 per month. This membership will include every perk that comes with basic level. Additionally, our Super Supporters can be a part of a WhatsApp group where we can have discussions and suggestions on various topics. The second perk includes a gift pack with our merchandise. And the third perk is a Google Meet with Mr. Sujit Nair, where you can join the meet and ask your questions to Mr. Nair face to face. Lastly, if you like, we would give a shout out to our super supporters in our programs. So, hope to see you soon with our badges.